Ramana, we're delighted to have this opportunity to kind of pick your brain, and you've been really studying the topic of innovation and venture capital for many, many years. We've seen over the last 2, maybe more decades, venture capital being instrumental to driving innovation in many walks of life. I was wondering if you can spell out what are some of the strengths or advantages of the venture capital model. Please go ahead.
Yeah, absolutely. So one of the things that academics like us have been studying quite a lot over the last several years is the ways in which venture capital is able to support these companies. Just to put it in context, in the US, for example, just less than 1% of companies, something like 0.5% of companies every year get a round of venture capital financing. But then over half the companies, or about half the companies that are going public every year, have received venture capital. So it's really disproportionately associated with the high growth, high impact, high job creation, high innovation companies. So one question, obviously, that academics spend a lot of time thinking about is the degree to which venture capitalists are just good at picking companies that will ultimately be successful, or do they actually help them become successful through their value-added work. And there's 2 quite distinct ways in which people have noted that VCs provide support. One is through governance. So they're there to make sure that the best interests of the companies, rather than necessarily just the best interest of the founders, are being taken care of. And there will be instances where the founders' interests and the company's interests might diverge. And strong governance can help with that, not just with publicly traded companies, but with private companies as well. The second is VCs obviously have a strong network associated with their work with the portfolio of companies that they have. And so they can use that network to bear to help find strong talent, potential customers, suppliers, and indeed they have a reputational benefit where the best employees might be more interested in joining a venture capital-backed firm because they know that there's been some amount of vetting that's taken place, that there may be capital that will keep this company alive for a certain period of time, and they're more willing to actually join and take those jobs.
Thank you very much for sharing these insights. I know that in some of your other work, you have looked at the persistence of performance across different vintages or in different funds. And I was wondering if you can help us unpack where does the persistence or challenges thereof comes to within the venture capital asset class?
Yeah, so one of the fascinating things about venture capital in particular, and private equity as a general asset class, is this persistence in performance across funds, which is something that we don't see in the public equity markets. And so one natural question that arises is, what's the source of this persistence? And clearly, the value that venture capitalists add is an important potential source of that persistence in performance. Some of the work that I've been doing and others have done suggests that, in fact, while there is persistence in performance in VC, there is also mean reversion. It just happens over a longer period of time. And one reason for that longer period of time before mean reversion fully takes place is the fact that venture capital deals are bilaterally negotiated deals. So it's not the case that just the best price will always get into the deal. If you've developed a reputation to be a value-added investor, you have the ability to come in and get a deal on more favorable terms than somebody else who may have given a better price but doesn't have the same reputation, because entrepreneurs value that value add that the investors bring to the table. And so one of the things that we've seen is that this persistence seems to come from access to deal flow, which is that you may have been helpful to companies and had a great return, It's not necessarily the case that you were that disproportionately better than the next VC. We know VCs in general add value, but differences in value add across VCs don't necessarily always translate to the differences in performance. Some of that appears to come from the fact that those who are initially successful are able to attract better deal flow, and because of that are able to perpetuate their performance over several funds.
So this is brilliant. If I take this insight about that kind of proprietary access to deal flow, and I take the starting observation of actually a fraction, less than 1% of all companies actually get venture capital, there's one question that comes to mind, which is, what's the best use case for venture capital? And maybe next to it, what are some of the challenges that we can see associated with the venture capital model? I know that you've been thinking about these issues. Can you share some of those observations with us?
Yeah, absolutely. I think venture capital is particularly helpful for companies where you can de-risk quickly and cheaply, and where the key risk that you face is market risk. And they have done a fantastic job over the last several decades, particularly the last 20 years, in helping companies get better at this early experimentation, addressing some key challenges around whether customers actually want to buy the product, what the unit economics are, and then transitioning to growth stage capital to help scale the businesses as they learn that those are actually viable companies. In general, venture capitalists have been less adept at taking on a lot of technical risk. And that's often because of the case that they don't have the strong technical due diligence capabilities in-house. One big exception is the biotech industry, which has indeed a lot of technical risk. But one of the differences in the biotech industry is that the milestones are reasonably well understood. So there is a bit of a playbook, and that playbook is dictated to some degree by the FDA and the milestones that are required by the FDA. In some areas like deep tech, which I'm particularly passionate about, things like renewable energy generation, carbon capture and sequestration, new sustainable materials, there is massive technical risk and there's market risk at the same time. And the two are quite related to each other. So the degree to which a technology works at a certain level, the unit economics, is going to drive which customers are going to be interested in that product or not. And so there is this deep relationship between the degree to which you are able to solve certain technical challenges and the size of the market that is open and available to you. In general, because the very strong IRRs that the VCs set for themselves, they often want to get 5 to 10 times their money in 5 years' time. It's hard for them to spend a lot of time and money on the de-risking side of things. And they tend to value correctly companies that are ones where you can learn quickly and cheaply. And so one of the things that we've noticed is that there's been a 5-fold increase in venture money that has come into the industry over the last decade. But almost all of that has come from information technology, software services, consumer and business products, where in fact it is possible there isn't that much technical risk, and it's possible to relatively quickly understand what's the key barrier to adoption, do customers actually want this or not, and then generate the unit economics that allow you to then begin scaling the business.
So this is fascinating. I think what you're telling us is that some of the challenges in driving innovation maybe outside the ICT industries is not the breadth of capital. In fact, as you mentioned, there's manifold amounts of capital flowing into the market over the last few years, but it really is this time horizon and the different type of risk, the technical risk that is what investors are facing. If I can ask you, you've clearly thought about these topics long and hard. If you can envision what might be a vehicle or what might be an entity that can potentially unlock these challenges and kind of facilitate further exploration and maybe commercialization of deep tech, what might that look like?
Yeah, so I think one thing that you brought up, which is a really important point, is that capital intensity itself doesn't appear to be a barrier for venture capitalists. We've seen hundreds of millions of dollars deployed into unicorns over the last decade. And And I think the reason why VCs are able to do that is because that money has come in to help scale the business. It hasn't come in to try to de-risk and learn whether it's actually viable. And so as we begin to think about where the friction lies, particularly with these deep tech kinds of businesses, one clear area seems to be the cost and the time taken to de-risk rather than to scale. I think a second thing to note is that these deep tech technologies are really important for solving global challenges, climate, sustainability, health. A lot of those innovations, the fundamental science and innovations that underpin these technologies, are increasingly coming from universities. And obviously the university incentive model and the ecosystem is quite different in many ways and not necessarily conducive to building businesses. The academics are often interested in their own academic enterprise. The university often thinks about patenting as a cost center rather than a source of value. And so as we begin to think about the sets of challenges that exist here in terms of the frictions, there's one clear one around technical risk, there's another one around talent, and then there's a third around thinking about business models and value creation, value capture. So one of the things we've been trying to do at Imperial is to use that kind of friction-based approach to understanding what are the barriers and what can we do to solve it as a way to approach a potential solution. And we've been working as part of this new Deep Tech Institute to put in place a structure that can perhaps do the best of universities, bringing that patient, non-dilutive capital that supports the nature of de-risking in science, which can, is unpredictable and requires time, paired with the strong technical talent, the lab space, the specialized equipment that the university already has, and so can be made available to these projects on a marginal cost basis rather than making the full fixed investment. And then pairing that with project management that we know is so important, the governance that we spoke about before, the value add around helping to bring talent and really understand what are the key technical and business milestones that the next investor is looking for, and how can we work backwards from those to try to achieve them so that then we have value inflection when we achieve those milestones. So we're at the very early stages of this. We've been working hard to conceptualize it, and now actually ran our first pilot in January. We gave 9 pre-ventures projects about £850,000, buying each of them about 6 months of runway. And there's been a very interesting set of learnings that we have begun to get from that, and we're in the process of thinking about how to scale it up as one possible solution to this big problem. I certainly feel like this is one of the grand challenges of our time. We talk about climate and health and security as being grand challenges, and I think that's absolutely right. But I also feel like the solutions to those grand challenges depend on technology that exists in universities and in many ways is stuck and increasingly stuck. And so if we don't solve, if we want to solve those grand challenges, we have to solve this other grand challenge of getting technology out of universities. And that's kind of what I'm excited about.
So thank you very much. This is clearly a very exciting experiment. I was wondering if you can help us think about, envision what would success look like down the line.
Yeah, so we have a very, I would say, ambitious and audacious goal here. One element of the goal is to support technologies coming out of Imperial, and we believe we have the ability or the talent pipeline to put about 15 to 16 companies per cohort per year over the next 10 years. So something like 150 or 160 pre-commercial ideas that are attacking big problems, have the potential to generate a lot of cash, but face technical de-risking that we can help reduce. So one clear goal is to help generate higher quality deal flow for investors, venture capital investors, by precisely delivering to them higher quality investments that are more close to what they need in order to make their initial investment. And so on one hand, I think we have an ambition that we would have something like 5 or 10 unicorns coming out of this 160, which is very proportional to the kinds of returns that you see in venture capital. But I think there's a broader set of goals here. One is to really develop a deep understanding of the frictions associated with building deep tech ventures. And much the same way that we have a great understanding of information technology and a great understanding of how to build these companies, and in the way that often universities like Stanford are associated with the information technology revolution, it's our ambition that Imperial plays a really important part in driving the understanding of the barriers to commercialization of deep tech, and indeed helps to develop a framework and a set of tools that can help practitioners as well as policymakers think about evidence-based policies that can support deep tech. And I think beyond that, kind of bringing it back to the UK, one thing that is interesting and an ambition for us is to develop a strong deep tech ecosystem. We have incredible universities in the UK. If you look at the league tables in the world, 4 out of the top 10 universities are from the UK. There's very strong scientific talent. There's a government that appears committed to trying to really get behind science and technology. We have a great financial services industry here that can really think creatively about the sources of capital. And we have a very strong tech community of entrepreneurs. And so I think all the ingredients around building a great deep tech ecosystem are there, and it's really about trying to support the city, the universities here, the country achieve its potential.
Well, it's really great to be here with you as you are embarking on this important challenge. I think that when all of this will come to fruition, we'll all be better off as a result of that. Thank you so much for sharing your insights with us. I really appreciate it.
Thank you so much.